Hello and welcome to another Targets in Focus, where we ask an expert to give us their forecast on a variety of currency pairs for the short, mid and long term. Today on the line I have senior FX strategist Sebastien Galy from Societe Generale. Hi Sebastien. The dollar has recently weakened over speculation that last month's Federal Reserve meeting will mean the central bank is getting to the point where it may increase its stimulus program. And at the same time, a recent survey by a notable financial publication showed that many people think the euro will still be around in 2 years' time. What are your predictions for the euro dollar in the short, medium and long term then?
Sure. I mean, our forecasts for euro dollar are driven in part by the Fed. Mostly, if not, it's driven by what's happening in the eurozone. We do expect that eventually the Fed to go for QE. We do expect that the minutes of the FOMC may show some willingness to twist a little bit more or be a little bit more aggressive. However, going forward, the main story is one where the euro is weakening, and it's weakening for, I guess, two main reasons. One is there's been a heavy amount of repatriation which has happened in the past few months, which has supported the euro dollar, simply because Europeans are basically shoring up their balance sheets, selling some outside assets. And now that process is gone, and that is leading euro dollar to move lower and faster. At the same time, I guess, which is the second main factor, is that the ECB is starting to cut rates, with Denmark being forced to cut rates into negative, which is quite a premiere on that side. And it means that the euro or euro area currencies are becoming increasingly interesting as a global funding currency, and gently replacing the dollar, but it's certainly very far from being there. So for us, it means euro dollar has a certain tendency to want to go lower. It's a very heavy position from a speculative point of view. Nonetheless, the grind lower from our point of view should continue heading towards the 121 area. We've identified in a major survey of large institutional hedge funds and corporate investors, as well as some market makers, where people would buy, and we figured out that the main buying level is between 118 to 123, so the current area where we are operating. And the next level is 115. Next level is 110 to 112, falling to 105, and then it goes very brutally down to 0.80. So that gives you essentially the mental picture. The Americans are very, very bearish, would buy 105. The Europeans are more optimistic at 112. The Asians are the most optimistic at 118. So for us, it's mostly grind lower in euro dollar. As long as nothing breaks in the system, that should basically steadily mean a move below 122, 118 in a year's time. Now,
you've decided to keep your 1, 3 and 12-month predictions for the cable at 1.57. What's the reason behind this?
It has almost nothing to do with sterling in the sense. The way to trade sterling is euro sterling. It's not sterling dollar, so the GBP versus USD. We expect actually euro sterling to steadily move lower in the direction of the 0.76 level, probably reach by year end, if not a little bit later. Again, it's a consensus trade. Even our analysts would argue that equities in the UK are actually fairly attractive, but it's mostly safe haven move out of the eurozone into sterling. That process should continue from our point of view. As sterling increases versus the euro, it compensates for the fact that the euro is falling against the dollar. So net nothing is happening in sterling dollars. The UK is doing well. It's a safe haven. The dollar is a bizarre safe haven, but it is a safe haven, and both of them are more or less trading in line with each other. The main variable of adjustment at this point in time is the euro decline across the board, and that is our core call. We're short euro dollar, we have been for a long time, and we're short euro sterling, we have been also for a long time, and we'll maintain these core positions in the coming months.
Finally, we know the Swiss economy has been on the rise of late. Should the SNB continue to defend its current rate limit of 1.20 francs per euro?
The SNB is holding the floor very easily, in the sense that it is positioning itself by switching out of its euro holdings into dollar holdings, protecting itself against a worse event. That means it's actually making money on average, actually fairly large amounts of money whenever things go wrong, which is what a good central bank is positioned to do, and the SNB is doing a great job at it. That is one of the reasons why the euro Swiss is interesting, because under any form of pressure, we suspect that the Swiss National Bank is actually aggressively selling euro dollar. That means euro dollar is being pushed lower by the SNB. So I think that's been one of the accelerators downwards in the past weeks in euro dollar. From a currency point of view, it's essentially a range trading. So if you're a very sophisticated trader, you're going to trade it via spot or via vols and have some fairly sophisticated algos. But overall, it's a fairly boring trade since we've entered into essentially a peg. Now, as the month go by, the SNB will be in a bind in the sense that there's a lot of liquidity flushing around into real estate in Switzerland. We've already had some blow up on some sectors of the housing market last year, and particularly the commercial side. That has already subsided. That will come back again. The problem that the Swiss National Bank has going forward is that it cannot really control very well the process, because the people who have the money actually have the money. They do not need to necessarily to borrow from different banks, and they can easily borrow because they actually have very, very good balance sheets. So there's a lot of wealthy people in Switzerland. There are a lot of foreigners also wanting to invest in Switzerland, which has helped to prop up the bubble last year. So the Swiss economy is still suffering from deflation. More recently, it's a good deflation because it's being led by lower energy prices. The economy is doing well, but the global picture is not too encouraging. And even though Switzerland is a great manufacturer of high added value, and I do say that holding my Swiss watch on my left wrist, it does have an issue because global demand is actually weakening. So they will have to maintain a very loose monetary policy, which means they will have to hold the peg for longer, and we believe that they'll be able to hold the peg even if Greece leaves, and even in, or most probably in very dark scenarios for Spain and Italy.
Thanks for that, Sebastien. Well, that's all we've got time for at the moment. Targets in Focus will return once again on Friday to bring you further expert analysis on a variety of currency pairs. But for now, goodbye.